My trading account is more than 50K now. Do I have to trade more careful while scaling to 100K or switch to HTF? Higher timeframes. This is what this guy's asking. Okay, so the first thing is you're gonna have to monitor your slippage per trade, because when you're trading with a 50K size, this is when, and if you're on the 1 minute time frame, you might start getting hit by slippage a little bit more frequently than if you were like at 20K size before. So you're gonna have to start monitoring your slippage per trade. So in your trading journal, you might want to add a column, and you just want to call it slippage. And in that column, you just want to write every single time you get hit with slippage, just write whatever that number is. And make sure that you get a good feeling for what is your actual average slippage per trade. And if this number starts creeping higher and higher and higher, you might want to reduce your size before you can address it. So the first step is you want to start tracking or monitoring your slippage per trade in your journal. After you start monitoring it, the next thing is you want to try to reduce your average slippage per trade. So there's a couple of ways to do this. The easiest immediate way to do this is to execute the exact same trade, but on multiple exchanges at the same time. Why? Because when you're using multiple exchanges for the exact same trade, you get access to more liquidity, as in like more limit orders with your market orders. So you can spread your market orders between multiple exchanges. Therefore, your slippage goes down on the exact same trade. So this is like the easiest thing that you could do to instantly drop your slippage. Just trade on multiple exchanges. The second thing is TWAP. This stands for time weighted average price. What it basically means is that let's go into this example. Let's say that we wanted to execute this trade with 100K size. And we wanted to enter with 100K. We don't have to click a single time with 100K as soon as our entry condition is met. What we can do is we can enter with 30K slightly before the trigger, because if it's so close, like if the trade is so close to triggering the entry conditions, like the closer it is to triggering the conditions, the more likely the trade is actually going to confirm versus fake out, right? So as it gets closer, really close, you can already put on like a starting position, like slightly earlier before you even enter the trade. And let's say this is like 30K or 33K. Let's just pretend 33. Then as it confirms, you can throw on another 33K. And then maybe like one candle after you've entered the trade, you can throw on the final 33K. And then average price of your entry is going to be the exact same as if you entered normally, right? So you get the exact same entry price, but the average slippage per every single one of these orders is going to be lower because you're hitting 33K against whatever is in the order book at the time. Then again, you hit 33K with what's like available at the time, and then again you hit 33K. So like average slippage, let's say per one of these orders could be like 1 basis point, 1 basis point, 1 basis point. So your average slippage per trade would be 1 BPS. But if you hit in with the full 100K, like you hit in full 100K market sell, like at the time when you get your entry and you just market sell 100K, you might get slipped like 10 basis points, right? Like 0.1% in slippage. This is, for those who don't know, 0.1% is 1 basis point, 1 BPS. This is just easier to say than 0.01%, right? So 1 BPS. Okay, so that's one thing that you could do. An alternative thing that you could do is once you get your trigger to enter the trade, you could split your 100K order into 100 $1,000 orders, or even more crazy, $1,000 $100 orders, and they're all going to be executed over a 60-second period of time, right? So it's like rapid fire $100 orders over the next 60 seconds. This can often, not always, but often this can reduce your slippage per trade, because uh, a lot of market makers, because not on all coins there's not just one market maker. There's often like more than one player who is making the market. If there happens to be more than one player who's making the market, sometimes whoever is making, or whoever the entity is that is making, is not, it doesn't have their bot as so sophisticated to detect a TWAP. And what will happen is the market maker will go and quote, let's say, a $1,000 order, and then you you hit it with a $100 order, so then 1,000 gets dropped to 900, and then after it drops to 900, they just refresh it again back up to 1,000. So you can basically get filled for your desired price. You can get filled for a larger of your desired position size for your desired price, compared to if you just slam in 100K, you're just going to slip the book, right? You won't be able to take advantage of the fact that there might be an unsophisticated market maker who is refreshing their orders, because a lot of the time when a market maker does get partially filled, they will just refill whatever was partially filled with their order. So that's another way. Then I'm pretty sure there are tools where you could like randomize your orders to make it harder to detect that there's a TWAP. So it could be, I'm going to execute a trade. I'm going to execute a 100K position over the next 60 seconds, but the timing of the orders isn't going to be every 1 second. It's going to be every n seconds, where n is a number between 1 and 5, and it's randomized. And also the position size that I'm going to get between these 1 to 5 seconds, it's going to be a random number between 100 and, let's say, 1,000. And then by the time that we get to the 58th second, on the last 2 seconds, we're just going to mark it. We're just going to mark it by whatever the remainder is of whatever is left to fill, basically. So we get slipped quite heavily on, or we get slipped harder on the final 2 seconds, and then we get, just so that we can get the last of the position size on. But in the first 58 seconds, we're basically playing with whoever is market making, right? We're trying to get filled for as much as possible without the market maker realizing that it's just one entity who is entering a large position. If the market maker is in-house, they 100% will know, and they will adjust their quotes accordingly, meaning you will get slipped the normal size. But if it's a third-party market maker, it will be harder for them to tell, and they won't adjust their quotes as quickly, and you'll be able to get filled for a much larger size. So yeah, that's reducing slippage. Okay, another one, this is an interesting one. You can try to reduce your costs. So this is, if you have a friend, like before you sign up to any exchange, if you happen to have friends who are on that exchange, you want to ask them for a referral link so that you can get a discount on your fees, because most exchanges will offer discounts on fees if you can get onto a referral link, right? This isn't me shilling my referral link. I'm saying, like, I don't need your referral. I don't need your referral link coins, your referral shekels. I'm saying go to your friends, okay? Go to your friends and ask your friends for a referral link so that both of you can benefit, okay? Go to your friends, ask for a referral link, and use your friends. This applies to like most exchanges. So that's the first thing that you could do. The next one, and this is another reason why marketing is a big deal, and I think I mentioned this before, is that if you have some kind of brand on Twitter, on YouTube, on whatever, you can get a deal with the exchange to promote them in exchange for lower fees. So building a brand building a brand as a trader is so worth it. It's like so ridiculously like EV positive. It's not even funny. So absolutely would recommend growing your Twitter account or growing your YouTube, whatever, Instagram, so that you can get discounts on your fees with whatever exchange that you're on in exchange for promoting them. Okay, if you've already done all this, you're tracking your slippage, you are trading on multiple exchanges at the same time, you are trying to get your execution down, like really, really polished to really reduce your slippage per trade. If you've done all that, and you've tried to get the referrals and the deals with exchanges, whatever, the only real thing that you can do beyond that is you're just going to have to find new alpha, right? You're just going to have to find new edges, new strategies which have a low correlation to whatever it is that you're doing currently, so that you can trade it simultaneously with whatever it is that you're doing at the moment. So for example, if you have a momentum long strategy and if you have a style for trading momentum or trend following, or if you have a style for trading mean reversion or reversals, so you have one strategy for breakouts, you have another strategy for reversals. Both of these strategies are dependent on price moving up or down. So you could look into developing a strategy which is not related with price moving up or down, but related to something else moving up or down. So for example, funding arbitrage, price arbitrage, right? So completely new type of strategy. Alternatively, you could test if your current strategies of trading, if they work in new data sets. So what I mean by this is, does your current strategy, does it work in different markets? So if you trade altcoin perps, do you know if your strategy will work in equities? Do you know if your strategy will work in Forex or commodities, right? You want to test it. You want to see, because if it does, what happens? You're going to get more positive EV trades. You're going to get more good trades. You're going to make more money. So you want to test if it works in different markets. And you also want to test if it works in different time frames as well. But quick disclaimer with this one. This is going to be somewhat correlated to what you already do. So careful with this one. A bit careful with this one. Like, yeah, it's still going to work, but like what I mean is, if you are long, like let's say this is Pepe, right? And let's say this is the 5-minute time frame on Pepe, and you just got long. You don't want to jump on the 1-minute time frame and then jump into the same exact breakout long just because, oh, it's a different time frame, therefore it's a different trade. That's not what I'm saying. I'm saying, like, okay, maybe a coin doesn't have enough volume on the 1-minute time frame, but it does have enough volume on the 5-minute time frame. So you can take the exact same coin, the exact same trade on the exact same coin, but just different time frame, and just set the expectation that your trade is probably going to play out 5 times longer than normal. So if your average trade duration is 1 hour, right, on the 1-minute time frame, and you take the exact same trade on the 5-minute time frame, then it might take 5 hours before price goes and hits your target, right? But you can still do that. So you can absolutely do that and experiment like that. That way you can still get more trades without destroying yourself to slippage. But yeah, basically, the road from 50 to 100K, you don't have to switch timeframes. Like, you don't have to. It's just that you're going to have to really pay attention to your slippage and make sure that you're not destroying yourself to it. That's it. So pay attention to your slippage, try to reduce it over time, try to reduce your costs over time, and naturally you're going to have to go and look for more types of edges as well.